Yeah, we believe the retail investor has never been more empowered and never had a better experience. Strike selection, liquidity, and dynamic use of the tools to navigate the market so that you can be empowered to perform in 2022.
Hi, I'm Olivia Higgins. Here's what you missed in our latest NASDAQ webinar. The webinar, titled Options Trading and Investing Strategy for Uncertain Market Conditions, was held live on 14th December at 8 p.m. We talked to our experts Greg Ferrari, John Black, and Lee Yong Shern on how to best navigate the world of options trading and using strategies to maximize your investment tools. John Black and Greg Ferrari then covered an intro to options trading and what are options.
When we ask what are options, options are a contract and they provide the right but not the obligation to buy a security or an underlying stock. So that would be a call option. And then a put option on the other side of the trade is a right but an obligation, but a right but not an obligation to sell a security. Contract, and each options contract has an expiration date and a strike price in the future.
Yeah, I mean, to complement what John described as the baseline components of the contract, sort of the hallmark principles of the listed option markets in the United States is you have a what you see is what you get market. So you have market makers that have an obligation to provide continuous liquidity into the market, and they provide a bid and an offer that we stream through the NASDAQ platform. And the contracts that John described essentially enable investors to be able to achieve with certainty a price target for which options they wish to select. What you see on the screen on the Moomoo app is the price that you're almost guaranteed, by way of the enablement and the scale of our infrastructure and technology through the global capital markets.
We then went into how has options trading evolved during the COVID-19 pandemic.
Tremendous growth in the asset class, a lot of different investor types, notably newer investors have really gravitated towards options. And by way of that, options provides a lower notional entry point into a particular asset. So there are, tremendous companies, global companies that have their shares listed in the United States, and we as an exchange provide the ability to have options on them. So with Amazon at a $3,500 US stock, for one share, to trade 100 shares of Amazon, it's $350,000 US. And that's a significant amount of money for a Reg T margin account. So with options, obviously having multiple expiration dates in a term structure, it gives participants a much lower cost entry point that represents 100 shares without true ownership. A couple other trends that we're seeing more interest in trading shorter duration contracts. So, we about 7, 8, 9 years ago listed weekly options. So that was consecutive Friday expirations out to 7 weeks. So having multiple iterations. That now makes up over half of the volume in the industry today, right? In terms of short-term trading. So in the first or second Friday.
The next point was how to use options to hedge downside risks. John and Greg then went into how we can apply delta hedging using options.
These are things to think about when you're setting up your trades or you're looking to mitigate your downside risk. These are really basic strategies, but a buyer of an option pays the premium for the option, which has the strike and the expiration on a certain security or index. The seller of the option will collect that premium. So these are just the different types of ways and strategies that one could use on options.
How do you correlate the option that you're looking to purchase relative to the assets that you have? So having single stock concentration and then ultimately having an option that protects you, you have to be able to try to navigate sort of the complexities of the market vis-a-vis sort of your time horizon. So just be wary of that, and because not everything will line up perfectly for when sort of market timing and market events, take place, relative to your quote unquote portfolio insurance. But I think of delta in a very simplistic term, which obviously has a lot more characteristics to it, but is sort of the rate of change and the probability of your option being worth something upon expiration. So if you see a 30 delta option that you're buying, you're essentially protecting yourself for 30 shares.
The relationship between the stock and the option and the rate of change, and then the percentage likelihood of that option paying out. So as the value of the stock goes up, right, the delta will go up based for the strike, right? So and conversely for the put.
My personal favorite. We then went into most common strategies for options trading during times of market volatility.
Well, we really want to stick to the basics. And it's, when we talked about calls and puts, there's a long call, a long put, and then short call, short put. And those are some of the building blocks of option strategies. And it depends on your viewpoint. It depends on what you're looking to do for your portfolio. And you're protecting a portion of your portfolio if the stock were to go down. So that kind of strategy, if you have a concentrated position in Microsoft or Apple, Facebook, a single stock, and you want to make sure that you protect the gains that you've made in your stock, you would buy a put, and that would protect it. If it goes down, then you have a right to sell your stock at a certain price. And then on the opposite side, if you were to sell those strategies, sell a call, sell a put, those would be yield enhancement, where you're collecting the premiums because you don't think the stock is going to go past a certain point, or you're okay selling it there or buying that stock at that lower point if you're sold a put. A put can be looked at, if you're buying a put, as an insurance policy. There's a lot of folks that buy puts that never want to see that put exercise the strike price because they don't want the stock to come in, but they're protecting the downside. So it's almost like an insurance policy.
Selling an out-of-the-money call on that long stock position enhances your yield, typically on, whether it doesn't pay a dividend or does have a dividend, that you could essentially enhance your performance, but up to the strike. Someone may want to sell a call and then buy a put, for instance. So you use the upside of selling the call to finance having the downside protection for a dramatic single stock move.
And then we covered making a decision based on your market outlook. Finally, we learned how to utilize your option strategy to protect your investment portfolio.
Think of it as either like homeowners insurance or car insurance. You're constantly paying to protect yourself. And so if you have a bearish view and it did not realize, that outcome did not take hold, then ultimately you're constantly paying for the insurance without realizing the benefit of that insurance, of owning that insurance. So that is just becoming a much more popular strategy, is how do you finance your directional bias, and then how do you use the options market to do so. Utilizing index options, specifically what we see is the NASDAQ 100, which represents the largest non-financial growth companies globally and that are listed on NASDAQ. So you have a swath of securities. So that is Apple, Amazon, Tesla, Microsoft, Google, etc., all in one security, so packaged. So that enables you to have broad coverage, but what's also driving the market outperformance. So we're seeing a lot of investor demand to say, how can I use this throughout many different market cycles, market conditions?
In the ETF and your portfolio, but looking at what is your tolerance for risk and what is your appetite for the strike price. Do you want to see your portfolio protected 95% downside, or 5% downside, 10% downside, 15%? Like, you would have to look at your portfolio, figure out what your comfort is, how much you want to spend in premium.
Protection of the downside move of those products without actually having to worrying about physical delivery.
For risk mitigation, yield enhancement, portfolio protection, I think that what Moomoo, Futu, and NASDAQ are all doing, what we're trying to do is educate the proper use case. And that's why partnerships like this are so important to get that message out.
We then ended the session with a live demo training by Yongshan himself. And we took your questions during our live Q&A. Here are some of our favorites. what are the benefits of using options from retail investors' perspective?
We agree the shorter duration between the time of execution and the end of the expiration of the contract is gaining momentum and a lot of popularity, especially for passive investors. So I think of passive as looking at more yield enhancement as opposed to portfolio protection. So how do you constantly repeat that process?
Is it true that most option strategies revolve around profiting on major swings in stock price?
I'm going to take a stab at that. I think the key word here is most option strategies. Like, we never want to say most.
Right.
It's how you're utilizing this product. And one thing we didn't talk about is speculation, and that is certainly a way that people utilize the options industry. Everything that we've talked about is the classic use cases for buying puts, buying calls, selling both of those. There are strategies that people employ that try to take advantage of the major swings in the market, participating in the upside or buying the tails. So that is certainly a way people can utilize options. Most of those options end up worthless on that far end of the spectrum. But if you're buying an in the money call and participating on the upside there, that might be a different strategy. So it really depends on how you look at it. But to say most option strategies, I think that might be the word that changes that statement.
Find the right strike selection based on newer information that you have to be able to restate your thesis in the market.
As a lot of options expire worthless, or most in this case, there is a defined risk inherent to options where the purchaser of those options can only lose the amount of money that they put into the option. So if you buy a premium, you can't, if the stock goes down, if a stock goes to zero, you can only lose the amount of money that you paid for the premium of the option. So the risk is defined.
And so robo-advisors are clearly taking in a lot of data, analyzing portfolios, analyzing trends, and being able to facilitate delivery in some regards better than a human. But obviously having that hybrid approach is where we see a lot of the growing trends in the market.
What sort of financial products are most popular, and which are the best outperformers for 2021?
There's so many products, Olivia.
So
for a general question.
All right. So that is a great question. And I kind of stated it before, but from an exchange standpoint, we're not like advisors. We're not financial professionals in that regard. But that's the beauty of options and what options provide, and the tool that it is to portfolios and equity positions. It's more of an extension of the investment portfolio and what you can do with the product. So instead of looking at this as what's the market going to do, it's how can you set your portfolio up to capitalize on what you think the market's going to do.
Any last thoughts for our audience today watching, especially for 2022?
Yeah, we believe the retail investor has never been more empowered and never had a better experience. Strike selection, liquidity, and dynamic use of the tools to navigate the market are key things to remember today so that you can be empowered to perform in 2022.
We hope you enjoyed this rundown. What is the best strategy for your options trading portfolio? Leave your comment down below because I would love to know what you think. Like, subscribe, and stay tuned for more webinars like this. If you like the full access to the entire webinar, you can click on the links down below. We'll see you next time.